Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Swing Trading. And today we're going to be going through three methods that a trader might employ when planning what's known as a measured move swing trade, where we're measuring historical moves and using those to plan future trades. It should be an interesting discussion. A lot to cover. We're going to be setting a more precise agenda for how we're going to tackle that in just a moment. But let me first of all say hello to everybody who's joining us out there in YouTube. Hello there, Will and Greg, Ricebird, Robert, Scott, Beth, David, Lola, Sharon, Mary, Jim, E, Bob, everybody else. Thanks for joining us week after week. We always do appreciate your attendance, your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live presentation is concluded, enjoy the show. But be aware that you're invited to join the live discussion. This is a Tuesday webcast series, kicks off promptly at 3 Eastern time. Now, I'm not typically the presenter. I'm sort of filling in here. But yeah, we kick it off promptly every Tuesday, 3 Eastern. We'd love to have you here in the live stream. And as a little treat there for our live stream audience members, I have my very good friend, Kevin Horner. He's going to be riding side saddle with me. He's going to be hanging out in the chats, addressing any questions that I can't get to. Kevin and I have been now working together for years. So it's a great resource to have there. Kevin, thanks for having my back. Kevin and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters there on that platform. It's the best place to connect with us in between these live streams. Matter of fact, I was just on X just a few minutes ago, replying to some of the replies to some of my recent posts. Literally, about 10, 12 minutes ago. So yeah, if you want to follow Kevin there on X, you can find him there at Kevin Horner CS. You can find me on X at Cameron May CS. But let's get into this discussion. And of course, as we do, we first need to consider risks. This is important information, so bear it in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so today we're talking about swing trading, and we're talking specifically about doing what's called a measured move trade. And I'm going to be talking through three methods that traders might use to plan and place measured move stock trades using charts. So the first thing that we're going to do is take a quick peek at the S&P 500, see what's going on there. Spoiler alert, record-breaking day again today. Then we're going to use that as the backdrop to discuss swing trading. Now, there are three elements of swing trading, three common elements: an entry and an exit for taking profits, an exit for taking losses, which means that we have to plan in advance when we're going to do those things. Well, how might a stock trader know where a stock might go so they'll know when to take profits or when to take losses? Well, that might include a study of historical moves, literally measuring historical moves and using those to plan their trades. So we're going to go through some example charts today, introduce three methods for measuring historical moves and using those to plan trades. And then we're going to wrap things up with an example trade. All right, so let's go right to Thinkorswim. Let's have a look at what's going on with the S&P. We've broken above those February highs. Those February highs have been acting as more recently the lows of the markets, right above that 6,200 level for the S&P 500. And we've been going pretty much straight up off those lows. Although I will say it actually has been kind of a roller coaster along that way. Interestingly, 7 trading sessions ago, we came down, touched those lows, had a red day, a white day, a red day, white day, red day, white day, red day, white day. Yeah, just from day to day, some cyclical behavior there, but overall still moving higher. So let's today put ourselves in the place of a hypothetical swing trader who sees when they're trying to make that decision between doing bullish swing trades or bearish swing trades. We are going to be doing bullish swing trades. Now, I did get a comment in a recent webcast. Somebody said, I sure would be nice if these darn coaches would show the other side of the coin and demonstrate bearish trading behavior. Well, we do that. Yep. Now, we tend to do that more when the markets are bearish. But if you haven't seen recently a discussion of a bearish strategy, Make sure, first of all, that you subscribe to our Trader Talks channel on YouTube. You can click on the subscribe button. It only takes a second, doesn't cost anything, but this is where we house our previous webcasts on our Trader Talks Schwab Coaching Webcast YouTube page. You can go to our playlist right here and find our series of previous webcasts, or we can do a search. So if we have an interest in, bearish trading, maybe we just search for the word bearish and look at this. Here's a recent discussion of patterns on a stock chart for planning bearish trades. Anyway, just wanted to make you aware of that. Let's go back to the S&P 500. We are positioning ourselves for, yet another bullish discussion. But I want to talk about planning a measured move swing trade. Now, how many of you are familiar with that phrase, a measured move? Might be new to some of you. But here's the concept. Let's bring up a stock. I want to look at Oracle first. And I've made some drawings here. So if you're wondering where these blue dashed lines came from, it's not like it's automatically generated on a chart. This is where a trader applies their own discretion to a chart as in a study of recent history to see what has this stock done when it has made a move historically. Hey, Richardson, Lola, you're familiar with that phrase? Good. Sharon, yes? Great. Yeah, I can see 136 people watching the live stream right now. I would suspect a lot of you probably are regulars in this swing trading series, probably pretty familiar with this phrase, measured move. But I just wanted to get a little bit more granular with what precisely that means. But it is literally studying recent history with the hope. We all know it's not a guarantee that history will repeat itself, with the hope that maybe it will repeat itself, and that might help the trader to structure a new trade into the future. So let's see what Oracle has been doing since it started its ascent back here in April. This is right about when most stocks bottomed out. What we'll notice is that very rarely does a stock just go straight up, day after day after day after day. Instead, it'll tend to go in spurts, in sort of stair steps. And for our swing trader here, it's just those stair steps that they may be targeting as trading opportunities. Because if the stock has recently stepped up, that might give our trader pause. Well, let's wait for it to make its next step down and then plan a trade where we'll enter, figure out where we want to sell and take profits if profits manifest themselves, or figure out where we're going to take losses if losses are what occur. But how in the world does a trader gauge where a stock is going to go? Like if you look over the last couple of days, looks like we got a bit of what we call a spinning top doji right there. And we've started to get some white candles again. So maybe the stock is about to run. Well, the big question is, how far? And then a second big question is, how would we know if it's not going to make a run? And that's where this study of recent history may come into play. So I drew in some lines here. And what do you notice just generally about the nature of these advances? Here, their stock started to run, hit a bit of a price ceiling, and then gapped. Made another run, and then pulled back. It made another run and gapped again. Made another run and then pulled back. It made another run and pulled back, and another run and pulled back, another run, pulled back, another run, and pulled back. What you'll notice is that there appears to be some rhythm to this, a bit of a proportionality to the behavior as the stock is running up. So let's just, Greg says they're all about the same value. Now, is this the way a stock always behaves? Nope. But it does actually do this fairly frequently. And so if a trader notes this, let's just quickly gauge how large of moves we're seeing here. So here the stock went from a low around 120 up to maybe just a little bit above 140. We'll call it 142. That was about a $22 move. Then it had a gap up to about 144, and we ran up to about 164. That's about a $20 move. We pulled back down to about 154 and ran up to about 178. That's about a $24 move there. After this gap, we went from about 189 up to about 216. That was about a $27 move. So 20, 20, 22, 27. This one we went from 202 up to about 228. That was about a $26 move. This was a 216 up to about 241, about a $25 move. This one was from 224 up to 251, maybe about a $27 move. Here we went from 235-ish up to 260-ish. about a $25 move. Interesting. It seems like every single one of these has fallen between $20 on the low end to about $25 on the $27 actually on the high end. So we have a bit of a range. And so our trader here may be looking at this most recent move. And let's say that our trader thinks, oh, you know what? This time I think it's going to go $50. Is there anything recently that tells us that there's going to be an uninterrupted $50 move? That would be outside the normal recent behavior of this stock. Now, it's easy to sort of think of this stock monolithically as a creature unto itself, but actually what's happening here, there are human beings behind this trading behavior. And if human beings have behaved a certain way 8 times in a row, is there a possibility that maybe they'll behave in the same way for a 9th time? If human beings have been satisfied with a $20 or a $25 advance 8 times in a row, might it be possible that they're satisfied with a $20 or $25 advance again? So as we're starting up from these lows, maybe that can tell our trader what that topside expectation may be. Now, I always throw out some qualifying language here, what it may be, what might happen, because it's not a guarantee that's exactly what's going to happen, but still might be useful information. So if we're bottoming out here around 240, I'm going to call it 247. Where might a target price be? Could we say maybe 267? Possibly push that up to 272. That would be in that $20 to $25 range. That might be right up around here. This is sort of the literal definition of a measured move. We're literally measuring previous moves and then just duplicate it. And so that will create another $20 or $25 line for us, and we can just move it over to the bottom of our most recent move, and that can help project to the upside. And that, right, look at that. That takes us right up to around 272. Jay Richardson, did I freeze for just a second there? I actually saw a little blip from my end. It might have frozen there for just a second, but I think we're back on the line. Yeah, I don't know what that was. Any case, so what might the trader do with this? That could be their target. So when might the entry be? Well, after a pullback. Where might they plan to take profits? If the stock advances proportionately to recent moves, that may be the plan. Well, if that's the plan, that's the fun part. What's the not so fun part? It might also be the case that this trade doesn't work out. When might the trader pull the plug on this? Well, it could just be an issue of timing. Maybe the stock needed to go down further. Maybe the stock is reversing entirely, but in any case, if the trader is getting in on the evidence of a recent pullback and maybe a white candle, if the stock goes back down lower than that recent low, that might tell the trader time to, maybe let's wrap this one up, try to catch the next one if the upward trend persists. So in this case, let's say the target here might be, let's just draw that in. Actually, I don't even need to change my drawing tool. Let's just draw in a line up there at 272, representing a potential target based on measured historical moves recently. And where might the stop be? It might be just below this recent low. So the exit to take losses may be $1 or $2. It might be a percentage point or 2. I could give you Jim says, doesn't it look like it started a squeeze? Jim, you talk about this pattern in behavior. Guess what? That's a teaser for our next method for doing this. I'm not going to say it's a squeeze because that would take us off in a whole different direction, but I do see a bit of a pattern emerging, interestingly. But there can be a general little rule of thumb, or because you'll hear me say, maybe it's $1 or $2, maybe it's a percentage point or 2. Well, does a trader use looser or tighter stops? That actually can be a function of how much upside potential there is remaining in the trade. If the trader thinks there's quite a bit of reward left on the table, that may allow them to take a little bit of a larger risk and go up a percent, maybe an extra percentage point or 2 below their recent support. On the other hand, if their target isn't very distant, maybe they don't want to take a huge disproportionate risk. Does that make sense? Thea says, can I add RSI to my chart? I could, Thea, not going to. Nope, it would take us off topic for what I want to talk about today, but good question. I like that you examine other things outside of just the topic of the moment, because just because we're discussing one thing in a given webcast doesn't mean that this is the prescribed approach for trading, right? But I do like to keep the discussions targeted, keep them on track. So let's say for this one, seems like there's a decent bit of meat left on the bone there if we're able to get to that target. So maybe the trader backs off a little bit more, but ultimately they may have a plan to exit if we go back down below those lows. And that is what many would consider to be a complete swing trade plan using a measured move. An entry, a target, in other words, where to take profits, and a plan for taking losses if they happen. Now, this requires plenty of trader discretion. We just have to look at the chart. We kind of gauge where we think the moves have happened. We measure those. You'll notice I just drew these in manually, literally just drawing them in like this. Click, 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 click. Notice, was there any proportionality going the other direction? Pretty good. Click, click. Not always the same move, but similar distances traveled. I know I'm a tough coach, Dragon. But there's a related discipline of study with charting. So let's move on to method number 2, which isn't just using previous advances that we've measured, but using something known as price patterns. Because this goes back to the question that Jim E asked. Doesn't it look like maybe there is there's a squeeze happening? Let me clear up my drawing set. And Jim, I think this is what you're talking about. Recently, the highs have actually been going lower on this chart, while the lows have been pressing higher. There's a name for that. Squeeze is one. Consolidation is another. But this pattern of behavior is known as a triangle. And that is in the field of discipline, the field of study, in technical analysis known as price patterns. And for some traders, they assign these some significance because if history has a pattern of repeating that's recognizable, maybe that can give us some insight potentially into what the stock might do in the future. And one of the benefits of price patterns is that it delivers all 3 of the traditional characteristics of a swing trade: an entry signal, a plan for taking profits, and a plan for managing losses. Now, R1 says it looks like a wedge. This one I would actually call a symmetrical triangle. With a wedge, a typical wedge, I'm trying to see if I can spot one here on our chart. I don't see one right away, but with a wedge, typically the highs and the lows are going in the same direction. So a common wedge would look like this, an upward wedge. We'd have highs going up, but the lows going up higher. So it looks like a triangle that's pointing upward. Okay, this one, the highs are going lower while the lows are coming higher. So I might call this a symmetrical triangle. All right, but in any case, I do see, here's something else right here. What is this? Where the highs went sideways while the lows came up. This is known as an ascending triangle. And with whatever price pattern, it really doesn't matter which, whether it's a symmetrical triangle, an ascending triangle, a wedge, a head and shoulders pattern, either inverse or just traditional. What have I not mentioned? A rectangle, did I say that? Whatever. All of these have some common threads that run through them all. Number 1 is they generate specific entry signals. Number 2 is they generate a projected price target. Number 3 is they can provide a signal for when to manage the losses. So I wanted to use a different stock for this. Oracle actually has some examples. So you know what? Actually, I could use this one for now. When is the signal on a price pattern? Well, we look for a breakout in one direction or the other. Now, price patterns are typically grouped into one of 2 categories. Some are seen as being continuation patterns. Others are seen as being reversal patterns. As a matter of fact, I didn't plan this on Oracle. What might there be down here? Not a great example, but pretty good. Could be with a little bit of finessing, an inverted head and shoulders pattern. Okay, but when a pattern trader has trained their eye to start to recognize these patterns, they watch for the patterns, and then they watch for price to move out of the pattern. So the pattern recognition is the start. But then as soon as price starts to move out of that pattern, that's the signal for entry. So in this case, you'll notice we actually had price move out on this red candle day. That's okay. Price moved outside of this symmetrical triangle. That might be an entry signal. So that's element number 1 for planning a measured move swing trade. Element number 2 requires measuring the move. Well, how do we measure the move on a price pattern? Well, with price patterns, we measure the depth of the pattern. So that would be here. Let me switch up my line here. Let me remove this drawing. Let's clean up this one that's just hanging out in space because it's kind of cluttery. But with each of these patterns, we measure this depth, like this right here, the depth of the pattern. This pattern appears to be about, I still have my, I want to do a trend line. There we go. But there's the depth of our ascending triangle. There's our symmetrical triangle. The head and shoulders pattern appears to be about this deep, but we just measure from the top of the pattern to the bottom of the pattern, regardless of what that pattern is. And then we can use that as a general gauge or a guide. Let me duplicate this depth and position it up here where we started to break out, and that may project a target. Interestingly, on our head and shoulders, that seemed to be taking us right up here to that previous resistance. On this, now I have 2 drawings. Let's see if I can get the right one. Let's duplicate this drawing. Yeah, no, I just have 1 drawing. Here we had our breakout right there. Interesting to see where our next level of consolidation happened. Here we have a breakout here. So let's duplicate this. Where might our trader project our next move if we get a subsequent breakout? Maybe there could be a target up here. That looks like that would be around 278. Wiley, you're getting ahead of me. Okay, this is going to be our final spoiler alert of the day. Wiley says, fib, question mark? Guess what? Fibonacci tools are commonly used. That's going to be method number 3 for planning measured moves using stock charts. Okay, but if you're not familiar with price patterns, I've shown a couple here today. I'm going to go to another chart. We'll get a little bit of repetition with this, but do this. If you've already subscribed, just go to the Trader Talks homepage and you can just type in the word pattern and look through. There are 2 different general categories of patterns. You have candlestick patterns. That's not what we're talking about today. That's a single day's behavior, or maybe 2 or 3 days of behavior. Instead, what we're looking for are trading price patterns, Kevin. Nice. Yep. You can go learn about trading price patterns like this. Obviously, if I'm going to be devoting one webcast to 3 methods, I can't spend a ton of time on each method. But let's go back here to Oracle. Noodlebrain says, is it better to look at patterns rather than exponential moving averages? Some say look for stocks over the 200 EMA. It's a good question. And the answer is better is a totally loaded term. With whatever technical approach we're taking to planning and placing a trade, that trade includes the possibility that it might fail. So you're going to hear some traders that would argue, no, I use moving averages and buy off those moving averages. That's my preferred approach. And others say, I don't pay any attention to moving averages at all, possibly as a trend filter maybe, but instead I'm more of a price pattern trader. It's up to the individual trader. Just recognize that any technical approach carries the potential for reward. It also carries the possibility of risk. Okay. And anybody that says they've definitively determined that one is better than another, how's that even possible? There are thousands of stocks trading on an huge range of different time frames. And any data that was collected yesterday is outdated by today. There are millions of new examples over the course of a month that could disprove whatever, I don't know, data set. I tend to think that somebody might have been looking for confirmation of their own bias, and that's easy enough to find if we apply it to an adequate number of charts and as long as we squint hard enough. Yeah, that's my feedback there. It's just a loaded term, and it would be incorrect for me to say definitively that one is better than another. Okay, so let's go have a look at more price patterns. So how about we look at Morgan Stanley here for a second? So Morgan Stanley has what should now be a familiar ascending triangle. An ascending triangle is literally where the highs are going sideways, but the lows are coming upward. So price is ascending, but running into a ceiling. And it's the breakout of that might be the signal to the trader that it's time to get in. For price pattern traders, very commonly they see this as the coiling of a spring. And you can kind of see that in this ascending triangle. There's a big run up and a pullback. And then there's a smaller run up and a smaller pullback and a smaller pullback. It's like the spring is coiling tighter and tighter and tighter. We know if we wind up a spring, eventually it's pop. It has a bunch of energy that's built into it. And for some, they see that as the precursor to potentially a strong move in whatever direction the breakout happens. Now, in this case, we got a breakout to the upside. And with each of these patterns, these are traditionally seen as continuation patterns, a continuation of whatever price was doing before. But here's our entry event, breaking above the resistance level, breaking out of the pattern. So where might a target be set? Well, we just measure the depth of the pattern. So we could measure the depth of this triangle. We could measure the depth of this rectangle. But we just use that. Let's right-click, duplicate the drawing, and that may give us a projection for the move to the upside. That's kind of interesting. We popped up, hit a resistance, and started going sideways. In this case, wound up going into a rectangle, known as a rectangle, because when highs and lows are relatively equal, takes on the form of kind of a rectangle. Noodlebrains says, could it be a false breakout? Absolutely. That's why there aren't two elements to a swing trade, but a third element planning for just exactly that scenario. If it's a false breakout or a whipsaw or whatever we want to call it, just a failed trade. It's easy to say, I made a mistake. Did we make a mistake? If we applied our rules to a chart, if the trader is being consistent with their typical approach, maybe they trade lots of rectangles and ascending triangles. And this one fit all their criteria. It broke out just as they were hoping. And then it just was one of those trades that didn't work out. Was there a mistake made? Or is it just a fact that sometimes the stock is just going to do what the stock's going to do, despite what we thought what it should have done? All right. Yeah. So in this case, on a breakout with price patterns, typically, if the stock falls back down into the pattern, the trader typically doesn't have much patience beyond that. That's it. I thought this was the breakout event. It's looking like it's not. So we get right back out. So using the measured move to plan the target. Well, let's go in step-by-step sequence. Entry signal on the breakout. Plan the target using the measured move. Plan the stop as your third step below the breakout point. So here we have breakout from our identified price pattern. Target might be, let's do this, right-click. Let's duplicate our trend line. Tack it right onto the breakout point. Where does that take us? That takes us up to about 153.5. And our stop might be just below 145.5. It could be at 144.5, right down here. Okay, so that is method number 2. So manually measuring previous moves is by some considered to be their preferred approach to doing measured move swing trading. Identifying price patterns, studying and learning to identify price patterns is a second potential approach. And what's a third approach, Wiley? Wiley already asked. Some of you have already said, well, why are we doing this manually? Why don't we just use the tool that's built into the platform? It's called Fibonacci tool, the Fibonacci retracement tool. Let's click on this big percentage icon using our Fibonacci's. And let's go to a final stock example. I'm going to bring up BLK. So I have some arrows drawn in here to identify what Fibonacci traders commonly look for. So looking back again to that April start to the move for BlackRock, we know that our stock doesn't tend to go straight up and just keep going, but instead it'll tend to run up and then pull back, run up and then pull back. And what a Fibonacci trader will typically look for is, first of all, a big move to the upside. If they are swing trading, they're trying to identify when did this stock previously swing high, and then how far did it fall back before it swings up again. So in this study of history, we're going to look for these big swings upward, and then we're going to gauge how far back down do they come before they start to swing up again. So here was a big swing right here. Here was a big swing right here. Here was a big one right here. And I'm looking at the ones that were pretty much uninterrupted. Big one right here, big one right here, and looks like we're right in the middle of a new one. But let's use our Fibonacci tool and talk about how it might be planned for a trader. Maybe there are swing traders. Do you think, those of you who use Fibonacci's, do you think there are any Fibonacci traders out there right now with their eyes on BlackRock, looking at this big swing here and just waiting for the next entry opportunity? I think that's a possibility. I don't know for sure. But here's how they might use Fibonacci's. First, we choose our tool, Fibonacci retracements tool. Then we go to the peak of a big swing up. Click at the top. That's our first click. And then we go down to the bottom and click again. And what that does is it draws in these lines. Now, I've gone in great detail into how these lines are generated. You can go here to the channel again, go up here to the top, and type in, you can actually just type in Fibs, abbreviate it. That's fine. It'll still find my webcasts. But this is where we've talked just about trading with Fibonacci's. Okay? But our trader will typically look for that big upswing, click at the top of the move, click at the bottom of the move, and the proportionality of the expectations for the trade are sort of laid out automatically from there. And quite commonly, what a trader will be looking for is a pullback that takes us down where we surrender somewhere between a third and a half of the distance that was originally gained. So that might take us down to somewhere around here on this first upswing. So we ran up for these 3 days and pulled back. Interestingly, where did we bottom out? We bottomed out here on this day and here on this day, right around that 50% mark. And then we started a new move to the upside. Here's another one. Oops, I don't want to draw box. I want to draw fib. I'm going to click at the top of this move, go down to the bottom of that big move. And interestingly, how far down did we pull? We can't quite see that. Let's stretch out our y-axis here. So we ran up, we pulled back the next day to just between the 61.8 and 50% fib. This might be called the target entry zone, right there in that range. Okay, so that is a typical entry. Now, we've seen that actually repeat itself several times here. How about this one? Let's switch back to our fib. Here's our next big move up. Pulled back about to that 50% line. And you can see if a trader is buying there, in this case, and these are historical examples, we weren't in these trades. It's easy for your presenter to find these and say, look, we could have made a ton of money. Sometimes it doesn't work out. But in this case, it's interesting that we pulled back about 50% and then started to climb again. So a trader who purchased here, as a hypothetical, where might they have taken profits? Well, on these strong runs up, if we get that pullback, for some traders, they're okay just getting back up to the previous highs. So the entry is to get down here, get in back down here between 61.8 and 50, and then just target an exit if we get back up to these highs. That would be exit number one. Now, other traders may actually hold on and see if we can get up to the next Fibonacci level. That would be exit number two. That Fibonacci, if you're wondering where that came from, all that is just a measured move again. It's measuring this move here, and then assuming at least a 30% pullback, a move up from that line. So let me just kind of position it right there. You'll notice that takes us from here, after a pullback, up to that next level. So Black Shark 7 says Fibonacci is from top to bottom or from bottom to top. Top to bottom for bullish, bottom to top for bearish. Here's the difference. Let me right-click on this one. Let me actually, here's a trick. If you've been messing around with the y-axis over here, instead of trying to figure out where it was supposed to be, just come up here and click on these little double-headed arrows with the squiggle in the middle and change that to auto. And it just puts the chart back, okay? But yeah, if we're planning a bullish trade, we draw from top to bottom because that adds these projections upward. If we draw from bottom, let's look at one that was moving downward. And so here's a big strong move downward. Let's draw from the bottom to the top, and you'll notice it makes projections to the downside that are potential targets. Okay. But this is method two. I think we're already starting to see how the trade might be planned. What the entry signal is, it's getting down between that 1/3 to 1/2 retracement. The profit is if we can get at least up to where we were before, or maybe even all the way up to that previous, or up to the next Fibonacci projection. That's a measured move repeated. Well, where do we plan to take losses? Sometimes these things fail. Well, in this case, if the stock pulls down and goes beyond 50%, especially, let me fan this out a little bit more. In this more recent move, pulled up, dropped back, hit about 50%. If a trader got in here, that's great. It worked out again, terrific. However, if it starts to fall, if it falls down here below this 38.2 Fibonacci, what that's telling us is we've now given back about 2/3 of the distance gained. And maybe this isn't mere profit taking. Maybe this is sort of panic selling. And it could continue just going on down further. So getting down below that level can produce where the trader might plan to take losses. So if we were to look at that most recently, how about let's look at something where we can maybe put together a theoretical trade using our Fibonacci knowledge that we've just gained. Here's TE connectivity. There was a nice gap up here, measuring from the bottom side of that gap up to the top. That's quite a run. We went from 187 up to 213, about a $26 move on a $187 stock. That's a good move. And then it's pulled back. Interestingly, as we pulled back, we gave away. Let me stretch this out a little bit. There we go. Get that 50% line there so you can see it. It's interesting that we've come down to, or another way that I could do this, let's do this. Let's just switch our time frame. Let's change this from 1 year to maybe just 3 months. There we go. Make it easier to see those fibs. We've pulled down. You can see our traders had quite a few opportunities to maybe buy between that 61.8 and that 50% fib. And we're starting to rise here. So if a trader's taking an entry right now, where may they plan to take profits? Could be right up here at these previous highs. It could be that we shoot for getting up to that 161.8 fib. On the other hand, if the stock starts to falter, if it were to fall down below about 196.88 or below that 38.2, that's where whatever this enthusiasm was that got the stock going in one direction, maybe that's been surrendered. Maybe bearishness has taken over, time to take losses. So that's our third way to plan a measured move. That's our third method for planning and trading measured moves. So how about let's put this one into practice. Let's say that our trader is going to take our target 212.76. Let's just remember that. Our stop is going to be down there. Let's go just a little bit below that 196.88. Let's call it 196.77. I'm going to write that out over here. Target 212.76. Stop is going to be 196.87. Let's go put it into practice. Let's go to our trade tab. I'm going to right click on the ask price on our trade tab, and we're going to put in a custom buy order with an OCO bracket, which is a buy order with a sell order attached, 2 sell orders attached. Here we'd want to calculate how many shares we want to buy. 10 shares is going to be a $2,000 trade. That's okay. I'll just stay with that. Let's say that we're okay with putting in a market order. Our target was going to be at 212.76, unless my memory is serving me incorrectly. And our stop was going to be 196.87. So our target, we're going to make that our limit order. We want to sell for that price or more. 212.76 is the least we want to sell it for. Our stop, you can stop the bleeding. I want out at if we get down to 196.87 or lower. Let's make sure that both of those are good till canceled. And we've completed our trade plan. Now, I could click confirm and send this order off. I'm not going to today because I'm sort of the interloper in this webcast series. But this would be in order to buy 10 shares at the market price. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. We're not guaranteed that we're going to be buying it right at 204.20 or whatever. Sell if we can get up to 212.76. Sell if we fall down to or below 196.87. So could sell below that price. But with stop orders, there's no guarantee that the execution price will be equal to or near this activation price. I can send that order off, but I'm just not going to today. There we go. Guys, we've done it. 3 methods for planning and placing a swing trade using measured moves. So we can do it manually. We can use price patterns. Traders can also use something like a Fibonacci tool. What other methods can you think of? Chat them in. Let me know. Leave a comment. What methods can you think of that might be used in place of these 3 for doing a measured move swing trade? But guys, time for me to let you go. Hope you enjoyed the presentation. I have regularly scheduled sessions every day of the week. You're invited to those webcasts. I'll be doing my webcast tomorrow. I'd love to see you there. I also want to let you know that you should be following Kevin and me on X. You can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. Really is the very best place to follow or to find us in between these live streams. If you reply to one of my posts, I try to reply right back to you. It's great interaction that allows for, even though the camera is not on. Also, thank you to everybody that's already clicked the like button. 189 people watching. I can see 54 have already clicked the thumbs up. That's always appreciated. If you would just make a habit when you enjoy a webcast, click the like button. It's a pat on the back to the presenter for a job well done. It also gives a boost to that presenter's webcast, and the YouTube algorithm helps more people find these webcasts. All right. I think that's going to do it. I don't think I spotted a survey out there. Did I, Kevin? Nope. I think we're good to go. I'm going to set you loose. All right, everybody. Subscribe to the channel if you haven't done that yet. I will see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.